Hi. Make sure I got my water. Just a second. Oh man, I didn't bring my water up. Okay, yeah, that's how organized I am today. Okay. Basically, kind of got a few things that I want to say. I'll just let people sign in. Really annoyed that I didn't bring my water. Okay, have to do it without the water. Okay, so there's a few things that I want to talk about today. George, can you hear me by the way? Sorry, just like
Yes, I can.
That's fine. I'll just wait. There's a few people logging in. I'm in a meeting. Just drop it there. I can't. I'm in a meeting. I can't sign it. It's fine. I'll pick it up in a minute. Take it back then. Okay. Thanks. Bye. Sorry about that. Yeah. Okay. So basically, I come on these meetings and I kind of explain to people that what inflection investing is, and what I'm trying to explain is that it's not so much about the euphoria of having a good stock go your way. It's having a plan to know what to do so that you can go to your destination. Okay, so when I think about, for example, hymns obviously has done well for me, but I think that very few people would have had the stamina to hold on to that. So it's been 2 years and a bit that I've recommended hymns, and I recommended it at $5. And the same with other stocks, like maybe a more recent example with AppLovin. I recommended that, and along the way, even though AppLovin, for all intents and purposes, has been quite a stable stock, but for all intents and purposes, a lot of people kind of don't really know what to do. They're indecisive. So I'm going to go through kind of 9 rules that I feel that are really important to explain what my strategy is so that you can apply it to your own investment styles. Because like I'm human, you're human, you're not going to have the same stocks as me, and that's fine. But there are some principles here that you can apply, and I strongly believe that, for example, when you're driving, you're going somewhere, you're driving, and you put it on Google Maps, and you kind of get the place in the road, and the road's kind of blocked off, and it's like, oh, like what shall I do? And Google Maps is like, okay, you got a U-turn to go back, and you trust it because Google Maps knows what to do. There's a plan, they know what to do, and they kind of just follow. You just follow that, even though it's going back on yourself. This is the plan. I know where I am. I know where my destination needs to be. Now, this process of inflection investing isn't perfect. There are pitfalls, and if I'm upfront about the fact that there are pitfalls, and I explain to you, okay, what those pitfalls are, hopefully, when I'm done with this, you will be able to kind of, okay, go away and think about some stuff, and maybe you'll say, okay, this is some stuff that I can improve, because I come here and I do these calls, and it's great to see some of you, and it's really nice and stuff like that. But for me, it's like more rewarding to know that I made a difference to somebody, like, because freaking hell, man, like, I come out here and I kind of want to explain certain things, how to invest. And it's really, really important that if you take away these principles and apply it to your own strategy so that you can remove from your own process things that are tripping you up and making it more difficult for you to get to your destination. Okay, so I'm going to go through 9 principles. I'm going to do this quite quickly. I've already waffled a little bit. I'm going to open it up because last week there was quite a lot of people asking questions and stuff like that. And as I said, this is not for me, man. I know what I'm trying to do. And I think it's more rewarding for you to ask questions, to test what you know, put yourself out there, like it's easy to kind of stay back and stay quiet and just, be passive. But if you're not coming and you're not growing, then like don't bother showing up, I strongly believe that everybody comes to the market to make money, but it needs to be congruent with your personality. So my principles maybe don't apply to you. Okay, maybe like the way that I do things doesn't really resonate with you. That's fine. But there are things along this process that you can say, I haven't been doing that as accurately as I should. I'll give you an example. Okay, so when I look at my definition of what is inflection investing, I'm looking at myself and say, okay, what is the free cash flow of this business going to be 12 months out? I recognize that it's not a perfect line. And I recognize that even if I estimate that to the decimal point, and I'm right, the market may not always agree with me. Perfect example, HIMS. I've been recommending stock, and everyone, I read on Seeking Alpha as well, and everyone's like, oh, super bullish, super bullish, super bullish. And there was a consensus that it was like super bullish, but the market was like, okay, irrespective of super bullish, the market was saying for like a long time, the stock was just like dead in the water, like it wasn't really doing anything for anyone. So it's not a perfect system, even if you know to exactly what the free cash flow will be in 12 months, it doesn't mean anything. You need the market to come around, and sometimes you have to be patient, and this hurts everybody. No one wants to be patient. I get it, man. I want to make money. Like everyone wants to make money. No one's on this call because they want to lose money. But you really need to think about a little bit of patience goes a really long way. So this is my second point. Equally weight the portfolio. I used to have 7% allocation to each stock, but when you're wrong, man, that kills you. That really just obliterates you. And I said at the start about being congruent with your personality. That was causing me mental distress, and I wasn't happy at home. I was in a not good place, and I wasn't growing as a person. So I had to take a step back from that. I reduced the allocations to 3%. And as a consequence of reducing it down to 3%, I was able to regain my confidence as an investor. I recognize better than most people that we're in a strong market. I haven't seen a market as strong as this in my experience. 2020, in my experience, was not as strong as this. This has been a bananas market, man. But I had to go back, reduce those positions, get confident to the process to go forward. Now I am trying to go to 5%. Have approximately 18 stocks in the portfolio. Obviously, I know it rounds up to 20, but try and leave some cash on the sides, because you don't know that next week there isn't something that shows up. You're right. The market sometimes throws you something, and you don't want to be indecisive of what shall I do? Shall I buy? Shall I sell? Like, you don't want to be like that. You want to be ready as an investor. You don't need a lot. Like you just need enough for one position to just kind of rock and roll. Monday morning, let's go. So I believe 5% allocation works. Again, you may feel more comfortable with, let's say, having 30 stocks in the portfolio. That can be you. That's fine. And you might say, okay, I'm doing this 24/7. I just want to have 10 stocks in the portfolio. That's also fine. I would caution against that. I've been down that road. I've read everything about, Charlie and everything, and like how he had one stock position and it was fully leveraged and everything. But we are not Charlie. So, start from the process that you're not Charlie and you're not going to be Charlie. So just start from there. So when you have those positions, I strongly recommend having a 12-month holding period. That solves two problems. The first problem is that when you put something in your portfolio, you are 100% accountable to what you own, because you know that business is going to be with you for 12 months. And 12 months sounds easy peasy lemon squeezy when it's kind of like, the market's going up. But when you have a week of blood of like all red in your portfolio and you have 2 weeks, it's just emotionally draining. And if you have these kind of positions that are half-hearted, then you will just detest your portfolio and you'll sell. So if you're committed to holding that business for 12 months, you have to be quite decisive in what you put in them. So the second thing is that if you have this 12-month period, in my opinion, you do not need a stop loss. Now, this is contentious. There are all types of investors, and you may only operate with stop losses, and that's fine. But the downside of the stop loss is that and I suspect a lot of people on this call got triggered when Gig Cloud Technology fell 35% in that one trading session. When you have those stop losses, it's like you are having to react to what the share price is doing, and the market can go a bit crazy over like 2-3 week period, and you don't want to have to make a decision, and because it causes a lot of biases. So I believe in letting the time of your holding dictate your performance, rather than you trying to say, okay, I've got this, like I'm going to buy the dip. Like make it a strategy that you can implement when you're calm, full of serenity, and make it in a way that you're going to be happy to buy more with time. So this takes me to my next point, is that I used to believe that when it came to buying my stocks, I wanted to kind of buy it in 4 tranches. And nowadays, I feel that buying in 2 tranches probably works best. And the reason for that is that I'm not kind of being big-headed, but I feel like I'm becoming a better investor. And I feel like when I recognize something as ready to go, nowadays it's only taking 6 months or so to get ready to go. The best example I've got is Uploving. I recommended it was at the high about 6 months ago, and it basically stayed there. But now it's kind of okay. Now it's just like, taking off. And for that period that it was killing me, it was really, really difficult. And it was like an all-time high that I recommended it, but it was all-time high for that period. But now I look back, obviously it was a cheap price. So again, I feel that spacing it out by 4 tranches is too long a period. I think that having it a bit tighter works best. Again, as I said, take what you want from my strategy that applies to me, my personality. It may not apply to you. But I like to do that. And I like to see, if possible, after a quarterly period, how it lines up, the results, the guidance with all my expectations. So I got GitLab coming up that I recommended recently. I think it's next week or something like that. Maybe it's this week. Kind of everything just merges into one now. So I kind of made this, and like I don't particularly like recommending stuff heading into earnings. So I was kind of wanted to get it in last week just to kind of put it out there because it's something that I've been watching for a little while. So I found that my best trades are things that I've been following for a little while and building confidence. Now, my argument is to be quite selective in what you invest. So I follow a lot of stuff, and you have to become accustomed to recognizing that you are not going to call the top on any stock. Okay. So from the moment that you buy, I like to hold my period about 12 to 18 months. But I gave you the example of hymns that I've had it for 2 years, and obviously Builders First Source had it for 2 years. So Palo Alto I just sold, but it's been also 2 years. So, but I like to give this framework of 18 months. And I feel that if you're quite selective in trying to know what you're going to buy is really, really important. And I feel like there are some things that you can control. You can control the stock that you buy. You can control how much you allocate to it. But there are things that you cannot control. You can't control whether that stock becomes the next Netflix. You can't control whether it becomes the next Tesla or the next Nvidia. Like, don't look back with regret and say, oh, I wish I'd held on to Nvidia. Like, that's meaningless. Like, absolutely meaningless what you should have done. Like, who cares? Nobody cares about that. What you cares about is the risk. So you need to invest in a process that you think first about not taking losses. Think about that first. Make it, like we've discussed in many of our conversations, look at the balance sheet. The balance sheet is like your friend. It takes 5 minutes. Look at how much cash it's got. Look how much debt it's got. Like those 5 minutes, man, you make a killing there. And it's like the best return on your investment. Just look at how much like debt, like sometimes some businesses have a lot of jazz going on about them, but you look at it and his balance sheet is just like riddled. It's like it's an easy miss. And everyone's like, oh, the Sound.ai, I think it was like a recent one. I'm like, everyone's like, oh, writing to me, Michael, you made a bad call. That's okay. When you make a bad call on a stock that you don't own, it can't harm you. You're not going to get everything. I always say that I'm wrong 50% of the time because it is true. There are good periods when the market makes you feel like you're a genius, and then there are bad periods where through the cycle, having that understanding that you're going to be wrong 50% of the time, and you work hard to think when you invest, what can I lose? That's really like, you know, when the markets are so jubilant as they are right now, everyone's like, oh, what's the total addressable market of, like, all the analysts are like saying that. But I've been through these cycles, and I'll tell you that it switches. And when things turn sour, you listen to those calls, and people are like, oh, what are you going to do with the extra free cash flow? Are you going to buy back some of your stock? So it's that change, you see? It's like how I'm going to prevent further losses. And that's really what's really important when it comes to investing, thinking that process of trying to minimize your losses. Because when it comes to the end of the year, I want to know I delivered my 15% return. I did that. I did it. I said I was going to do it. I did it. But you need to be accountable when you invest to think about your losses. It's really, really important. Like, I don't know about you guys, but like, I've come from nothing, and it's taken me a long time to get here, and I'm not going back. I'm not going back there. And it's really, really important that when you invest, you have that accountability to somebody greater than you. Because if it's just about you, it's not really going to motivate you to think about those losses. Like, for me, I think a lot about my daughter, I think a lot about my wife. Like, if things were to go sour and, I was to get hit by a bus or whatever, did I lay down the foundation to give them a better life? So if you think about that, like what are you trying to do, what are you trying to accomplish, so that at the end of 2024 you can say, okay, yeah, that was good, we did what we set out to do. Okay, I've waffled on for quite a while. I'm going to open it up for questions, and yeah, hopefully you guys will take over.
Hello. Thanks a lot. It's very useful to hear this. So I have a question. It's not exactly. I mean, it's very related to what you say, but it goes like one step outside.
Mm-hmm.
So for me, a stressful factor is not only how big is each position, but also how big is my total portfolio compared to my total net worth.
Mhm,
I know this is not something you discuss usually
mhm,
because this is like we're talking about the portfolio right now,
mhm,
but I was wondering, you know, what do you think makes sense? Like, do you go all in? And because it's very risky,
mhm,
but also it has a bigger reward if you're like, I don't know,
mhm,
70% of your net worth is in one portfolio, right? That
mhm,
you really control. But at the same time, as you say, if you have a family and you
mhm,
want to make things a bit, more hedged.
mhm,
So what I'm doing, for example, is I have let's say, a big chunk in a very safe portfolio with ETFs, and then I
mhm,
have a smaller chunk that I want to have more control and I expect it to grow much faster. And that's when I use all your advice and
mhm,
I really try to beat the market there.
mhm. I like your
So
questions,
what do you think
Vasilis.
about this?
Yeah,
Hmm.
I like your questions a lot. Like, oh, you've been coming for a while, and I like your questions very much. So the way that I personally do it is that in my opinion, you need to leave 2 years of cash on the side so that when things go sour, and trust me, they will go sour, and everything goes wrong at the worst possible time, you're not going to be, reacting. Okay. Now you may find, okay, that's really, really difficult because I haven't got 2 years, but at the bare minimum, you need to leave 12 months because you don't want to have to be like, coming out, cashing out, because these things tend to work simultaneously, that the market goes sour, the economy goes sour, and perhaps your job goes sour. Things kind of seems to
Yes.
coincide. So at least 12 months, I would say, at the minimum, ideally 2 years. But I'll also say that I don't know which country you're from, but in the past, I've worked 3 jobs in a week. And when things go sour, you can you the human spirit is very, very able to adapt. Now, it's not the right place to discuss this, but ultimately, what you're trying to do is you investing in your family's well-being. So it's a lesson, right? You're trying to go and grow the portfolio size, and you have to be fairly honest with yourself with how active you are, because the market will kill you if you're not active in terms of buying and selling. If you're less active, then you can have less exposure. And if you're more active, then you can see it as an investment in yourself and you can be more aggressive. But be honest with yourself, not when the market is going up, but be honest with yourself and say, do I really have the time to be doing that? Because it is a full-time job. I grind all day, every day, weekends. Like, I'm always on the grind. So I kind of have a bit more of a sense of what's happening. That doesn't make any difference when the markets go sour. And there's no email to say, oh, the market's going to turn sour. It's just like, whoop, and it's like it just goes down. The whole thing, 20%, like bang, 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 hitting like Amazon, like whatever. I've seen Amazon trade like down like a penny stock, and like at the time it was like $1 trillion. So it doesn't matter about the size, it doesn't matter about anything. The markets can really take over. So you need to have enough cash on the side that you're not going to have to do something silly at a bad time, because nobody gives you a warning when it's a bad time.
Hmm. I see. I mean, definitely about the cash position, and about yeah, then putting some part of your stock positions in a kind of relatively safe, because it's very diversified, let's say an ETF of the world or something like that, as a kind of a hedging.
I don't agree with that personally. You
Mhm,
need that's something that it's for you. But
mhm,
I know from my experience that cash is like oxygen. You don't worry about it when things are good and you're swimming and you're dancing. But when things hit the fan, there's nothing like oxygen. You really need that oxygen to stay alive. And having a diversified portfolio of whatever. Look at 2009. It's like contagion. It's like it just kind of. Oh, look, even in 2020, like when things go sour, it doesn't matter like how diversified it is. Everything just kind of falls together. Personally, I prefer to have a bit of cash so that I
Mhm.
know that okay, that's my fallback. Once like I see it as like really being able to breathe through those difficult periods because in my experience where it's like oh I was it in 2022 I can't remember if it was 2022 or 2023 now. I think it was 2022 that it was like oh all these 60-40 portfolios which like 60% bond sorry 60% equity 40% bonds whatever all these 60-40 portfolios had the worst year in 40 years. Well, that's not going to help anyone when things are going sour. Oh, it happens to be an irregular period. Who cares? uh, so in my you sound like someone that's quite active. You come on these calls. In my experience, it's much better to invest in yourself. There's no better return than investing in yourself. I personally would not consider having those what is called it's not risk-free portfolio. It's a portfolio free. No, I'm messing this up. I forgot the quote. Basically, that having these diversified portfolios don't really protect you, and like it just they don't, man. They don't. Like if you've been through a few of these cycles, they don't. It really doesn't.
Okay, thanks a lot. That's a great input. Thanks a lot.
Michael, if we're considering establishing a new position, let's say for a stock, do you recommend? How should we think about the amount of research we should do in addition to reading, your analysis
Mhm.
before establishing, the first tranche?
Yeah. So um, it's a difficult question. So I always say to people, whatever you do in your life is your responsibility.
Mhm.
Whether you're opening the car door or cycling down the street, it's on you. No, you can't blame someone else for anything. Um, I believe that when things turn sour, like they did with Palo Alto Networks last week, that I am saying, okay, hey, listen, trade alert, this isn't working. So I believe that my experience should be that you don't need to do any work. I believe that. That's what I get up in the morning for. That's what I put in my efforts. That's why I study a lot. Um, my experience, I'm selling my experience to you so that you don't need to do that work. That's what I strongly believe. But you know, we need to be grown-ups as well and understand that when the market is going up, everyone's like, oh, it's Michael's killing it, blah blah. But you need to be accountable for your own actions as well. I know it's kind of a wishy-washy answer. um I don't have an easy answer for you. When I go on these calls, I think about it like, if I was trying to help my mom invest, what would I tell my mom that would help her understand what I'm trying to do? So I've made blunders in my picks and I will continue to make blunders. But I genuinely believe that the work that I'm putting in alleviates you of the work that you have to put in. I do think that, yeah, I mean, reasonably, I believe that you can go quite blind and follow me. It's my capital on the line. I work really, really hard. But that doesn't stop things like Palo Alto happening, and if the stock is down 30% on before the open. So I do genuinely believe that having a diversified portfolio protects against some of that. I've got like 18 stocks. Um, but I also know that the majority of people will not own all 18 stocks. I put that out there and it acts like an anchor to my returns. My returns will be a lot higher if I had 14 stocks, but I put more stocks, I diversify, it slows me down, but it gives the person the opportunity, the hypothetical subscriber that copied my portfolio, to really kind of, follow me blindly. But most people, and you probably as well, even if you've been on the service for, let's say, 6 months, you wouldn't have all the stocks in my portfolio. You'd have the ones that you feel, this appeals to me more. So it's difficult answer, but I kind of hope that I've been able to provide some context.
Listen to Zoom.
Does anyone else want to ask any questions? No one else? Okay.
I have a quick question.
Yeah.
Yeah. In terms of like rebalancing, how do you look at it? Like you have like stocks that really run up, and when do you take like some chips off the table? When do you do that? Or do you just, when the story changes for you, then you sell the whole position?
So I'm trying to, this is ultimately the question that you're asking, is when to sell. That's really what you're trying to ask. And I strongly recommend letting time lead your decision, but don't overstay your welcome for too long. So for example, with Palo Alto Networks, I overstayed. And when I bought that stock and when I recommend that stock, it was a relatively low multiple. And over the course of 2 years, people's expectations became so high. And it wasn't that the results itself were particularly shocking. It was more the misalignment between people's expectations and the future growth rates of the business. So I'm not perfect, but I'm trying to work on that a lot more to kind of cut it a little bit closer, the period to, let's say, 18 months. So I like to do the 2 tranches when I buy, and then I like to give 12 months. And then I'm very upfront and honest. I say, okay, after 12 months, I say, okay, this is the price target like that I'm looking at. So for example, I recommended Palantir a year ago at $10, and it went to $7. So it's a 30% drawdown. Obviously that hurt, that was painful. And now it's at 22 or something like that. And I said, okay, this hits 30, which will probably be like at some point this year, by the end of this year, and that's gone. So I made that position, and I did buy a little bit, but not a lot to change like my average cost. So I let the time, those 18 months, really be the rule, rather than the share price is up, because you don't know how fast things can move. So rather than reacting to the share price all the time, I think that, and trying to rebalance because it kind of, you feel like you have to do something, just be patient. And once it's hit the period of, let's say, 12 to 18 months, just call it a day. And yeah, put it as cash. I know from experience that I'll find something else. I always find something else. Sometimes, it takes 4 weeks. Sometimes it takes less. The harder I work, the quicker I tend to find these things. But I don't want to rebalance because, for example, things that are working well, why should I sell something that is working well just because it's working well? Like the guy that's buying Palantir at 20, he doesn't know that I bought it at 10. He doesn't know anything about me. Why should I sell just because he bought it at 20? That's his problem. So don't rebalance like that because the share price is moving. Maybe the company is becoming more profitable. No, just let the time do its thing.
Thank you. Yeah.
Okay. Anyone else want to ask any other questions?
So next week you'll continue this because I don't think you got through all your 9 rules.
I wrote this up, and it will be published on Friday. I put together 2 lots of them because I kind of, the way I was speaking, and kind of united them. but you will see that there are 9 when I write it up on when I publish this on Friday. Okay. If no one else has any more questions,
Here's a quick question, Michael.
hiya.
There's a significant amount of insider selling being done by individuals that I follow. And what I know that insider selling can be done for many different reasons, but it seems like this confluence of a good many wonderful minds is giving us a warning. Do you pay any attention to that at all?
None at all. Is it a particular stock that you're talking about, or just in general?
No, I'm talking about several.
No. Look, I'll give you the best example that I know of, which is Steve Jobs, I think, owned no shares of Apple, and I think it might be like the second biggest company in the world. So that made no difference whatsoever. People like whatever, man. People will do whatever they want to do, but no, like focus on the free cash flow. Like, and sometimes I call this wrong, as you know. Like you and I were talking about Antero. I owned this Antero Resources for longer than I cared to, and I took a loss in the end. And I make mistakes, and it sucks. And that's life. But
well, that was a commodity stock, and those are difficult.
Those are difficult.
Another one that you recommended, UEC, the uranium stock. It's been weak, very weak here in the last month or so. Any comments on that?
So there are 2 stocks in my portfolio that I will not sell. This is Uranium Energy Corp and Enovix, which makes the batteries that will go in some smart devices. These are my kind of moonshots. I will not sell this. Particularly because you're asking about Uranium Energy Corp. Man, until I see that the uranium price is back below $60, I'm not selling. I'm sorry. I'm just not selling. Whether people go on a whim and it's like, oh my God, like whatever. Remember, for them to be profitable making uranium, it's about $65 to $70 that it needs the price on the spot market. So, and you can't just make a new uranium mine tomorrow morning. It's not like a coal mine. You can just go there and dig it out. Like, to get a uranium mine going, it takes a long time. It really takes so much regulation and approval, and there's going to be a massive deficit. And until that, I see that the uranium price in the spot market is below 65. I'm sticking with it. I'm not giving up. Whatever. Like, come hell or high water. This one and Enovix, I'm just sticking with it. Whatever. Then they'll have to take it from me.
All right, good answer.
Okay. Don't think anyone else has any questions. Thank you so much, everyone. I really appreciate you guys coming. If you guys have any other questions that you want me to talk about, I do this for you because I want to help at least one person. Like if one person on this call comes up and says, Michael, I had some bad habits of investing. I don't mimic your strategy 100%, but you've put me on the right path, man. If one person I can help, man, that's great. I feel like this is really something motivating, very rewarding. So, reach out, ask me some questions, and I can kind of put some webinar about it. Okay. Thank you so much, everyone. See you next time. Thank you.
Thank you, Michael.
Thanks a
Thank
lot.
you, Michael.
Thank you, Mike.
Thank you very much.
Thank you.